You're buying a home. You found the one. Sunlight pouring through the windows, the smell of new paint. Your future. You sit with your lender and bam! Your interest rate just jumped. Not because of your credit score, not because of the bank. It happened because someone in Washington raised their eyebrows at inflation. That invisible hand, it belongs to the Federal Reserve. It doesn't sell products. It doesn't run ads. But it can raise or crash markets with a single sentence. It can make your credit card debt more expensive or your savings account more rewarding. It is, without exaggeration, the most powerful economic force in the United States, and maybe the world. But what is the Federal Reserve? How did it get this powerful, and why should you care? Let's pull back the curtain on the Fed. The origin of the Powerhouse. It all started with a crisis. The year was 1907 and Wall Street was in free fall. Banks were collapsing, businesses were going under, and terrified citizens rushed to withdraw their life savings. There was no safety net, no central institution to step in and calm the storm. In the absence of a federal response, one man, the wealthy banker J.P. Morgan, personally orchestrated a rescue effort by rallying other bankers to inject emergency liquidity into the system. It worked, but just barely. That financial panic exposed a dangerous truth. America's economy was growing, but it had no steady hand guiding it. Without a central authority, the financial system was vulnerable to fear, rumors, and chaos. The wake-up call was loud and clear. The United States needed a central bank. So in 1913, after intense debate and political maneuvering, Congress passed the Federal Reserve Act, giving birth to the Federal Reserve System, an institution designed to stabilize the economy, prevent banking collapses, regulate the money supply, and restore public confidence. But the Fed was no ordinary government entity. It was purposefully crafted as a hybrid, independent from day-to-day politics, but still accountable to Congress and the American people. This unique design, a blend of public oversight and private structure, was meant to balance power and prevent corruption. Over time, the Fed evolved from a financial firefighter into the architect of monetary stability. No longer just a last resort savior, it became the command center of the U.S. financial system, the one pulling levers behind interest rates, inflation, and bank regulation. From the chaos of 1907 emerged a powerhouse. And that powerhouse, the Federal Reserve, would go on to shape not just America's economy, but the entire global financial order. What is the Fed, really? Think of the Federal Reserve like a three-headed creature. The Board of Governors in Washington, D.C., the 12 regional reserve banks scattered across major cities like New York, San Francisco, and Atlanta. The all-powerful Federal Open Market Committee, FOMC. Together, they make up the Fed's spine. But it's not just bureaucratic alphabet soup. Each part plays a role in controlling the gears of the economy. The Board of Governors, a team of 7 financial wizards appointed by the President and confirmed by the Senate, set core policies and long-term direction. They're like the strategic brain. The 12 reserve banks act as boots on the ground, researching local economies, managing payment systems, and supervising banks in their districts. They make sure every corner of America has a voice. Then there's the FOMC. This committee decides interest rates. You know when you hear, the Fed raised rates today? That's them. They meet 8 times a year and every meeting can shift the global economy. This structure isn't just for show. It balances local input with national priorities and insulates decision-making from the chaos of political headlines. In short, the Fed isn't one bank. It's a carefully orchestrated system that quietly steers the economic ship, while the rest of us focus on our daily lives. The toolbox, how the Fed pulls strings. So how exactly does the Federal Reserve flex its economic muscles? It doesn't print checks for you. It doesn't approve your car loan or your student debt. And no, it's not watching your credit score. But what it does control is even more powerful. It sets the conditions that shape every financial decision you and your bank make. Let's break down the Fed's key tools. Its economic toolbox that quietly but massively influences your daily life. Number 1, the federal funds rate. This is the interest rate banks charge each other to borrow money overnight. It might sound like inside baseball, but it's the heartbeat of the entire financial system. When the Fed raises this rate, it becomes more expensive for banks to borrow money. That extra cost trickles down to you. Mortgage rates go up, credit cards get pricier, and even auto loans start to sting. On the flip side, when the Fed lowers the rate, borrowing becomes cheaper. encouraging businesses to expand and consumers to spend. Number 2, open market operations, OMO. This is where the Fed becomes the economy's biggest buyer or seller. It buys or sells U.S. Treasury securities to control the money supply. Buying bonds pushes cash into the banking system, making money more available and pushing interest rates down. Selling bonds does the opposite. It pulls money out of circulation and sends rates up. Think of it like watering or draining the economic garden, depending on whether the Fed wants to grow or cool things down. Number 3, the discount rate. This is the rate the Fed charges banks when they borrow money directly from one of the 12 regional reserve banks. It acts like a pressure valve. If the discount rate is high, banks are discouraged from borrowing from the Fed, keeping a lid on credit growth. If it's low, it opens the floodgates for more borrowing and more lending to consumers and businesses. Number 4, reserve requirements. This tool tells banks how much money they must keep in reserve and not lend out. Lower the requirement, and banks have more money to lend, boosting the economy. Raise it, and lending tightens, slowing things down. It's subtle but powerful. Together, these tools shape the flow of money in America. They affect whether your loan gets approved, how much interest you pay, and how far your dollar goes, all without the Fed ever sending you a single notification. The dual mandate, jobs and inflation. Now, what's the Fed actually trying to do with all this power? It has what's called a dual mandate. Promote maximum employment, keep prices stable, aka control inflation. If unemployment spikes, the Fed lowers interest rates to make borrowing easier. Businesses expand, jobs come back, but too much money chasing too few goods, that's inflation. Suddenly your grocery bill shoots up and your paycheck feels smaller. In response, the Fed raises rates to cool things down. It's a constant balancing act. Stimulate growth without letting inflation spin out of control. Think of the Fed as a thermostat for the economy, and sometimes it misjudges. After COVID-19, the Fed kept rates low for too long. Then inflation exploded. Rent, gas, food, everything surged. Suddenly, it had to raise rates aggressively, risking a recession. But that's the paradox of power. The Fed doesn't just watch the economy, it shapes it, with every percentage point and every pause. The Fed chair, the most powerful economist alive. Let's talk about the face of the Fed chair. This person isn't just a bureaucrat. They're one of the most influential voices in the global economy. Markets react to their tone, their posture, even a raised eyebrow, literally. Right now, that person is Jerome Powell. But history is packed with heavyweights. Paul Volcker crushed 1980s inflation with double-digit interest rates, triggering a short-term recession to stabilize long-term growth. Alan Greenspan guided the economy through the 90s boom, but was later criticized for missing warning signs before the 2008 crisis. Ben Bernanke pulled out every tool in the playbook during the Great Recession, inventing modern quantitative easing. Janet Yellen, now Treasury Secretary, was the first woman to lead the Fed and brought a worker-focused philosophy to monetary policy. The Fed chair is appointed by the president but operates independently. There's no guaranteed path to firing them midterm. That's by design. This insulation from politics lets the chair make unpopular decisions, like raising interest rates right before an election if it's in the economy's best interest. They don't just manage money, they manage expectations, confidence, and even fear. The Fed's critics. Not everyone's a fan. Now, with all this power, you'd expect some pushback, and you'd be right. Some critics say the Fed has too much influence with little accountability. It can essentially print money, bail out Wall Street, and affect elections, all without direct voter input. Others argue the Fed is too slow. During crises, it sometimes waits too long to act. And then there's Wall Street. Critics say the Fed's policies disproportionately benefit big banks and investors. For example, low interest rates can pump up stock prices but leave savers earning next to nothing. After the 2008 crash, the Fed poured trillions into rescuing financial institutions. Many ordinary Americans felt left behind. In 2020, they acted swiftly again. But inflation later made some wonder, did they go too far? Still, even skeptics admit, without the Fed, the U.S. economy might be a ship without a rudder. The key question isn't whether the Fed should exist, and that's a conversation we all need to be part of. So why is the Fed so powerful? Let's bring it all together. The Fed is powerful because it sits at the intersection of money, trust, and time. It doesn't just control interest rates, it controls expectations. When the Fed says inflation is under control, businesses plan, investors invest, and consumers spend. That belief, that confidence, is half the battle in managing an economy. Its ability to lend to banks in a crisis makes it the lender of last resort, something no other entity can match. Without the Fed, 2008 and 2020 could have turned into full-blown depressions. Its structure, independent yet accountable, lets it make tough decisions without being paralyzed by politics. And perhaps most importantly, it's forward-looking. Every rate hike or cut isn't about today. It's about 6 months from now, a year from now. That long view is what makes the Fed the steady hand in a stormy world. Yes, it's complex. Yes, it sometimes gets things wrong. But its power lies in what it protects: stability, liquidity, and belief in the system. Whether you love it, fear it, or never thought about it, the Fed is shaping your life, your wallet, and your future more than you ever realized. So the next time you hear the Fed made a move, remember, it's not just banker talk. It's your loan, your job, your rent, your retirement. The Federal Reserve may seem distant and abstract, but it's deeply personal. It's the heartbeat behind the dollars in your hand and the interest on your debt. If you found this breakdown helpful, hit that like button. It lets us know you're into content that actually makes money stuff make sense. Drop your thoughts or questions in the comments. We'd love to hear how the Fed has impacted your life. And don't forget to subscribe so you never miss a story that connects your world with the world of finance. Thanks for watching.